Most people see the financial markets as a battleground of only the most analytical and business savvy professionals. The proof is in the pudding. The people who have the greatest numbers, the greatest returns, obviously have some sort of strategy that gives them an edge over the rest of the market. But that's not necessarily the case. In my experience, I remember when I made a 6% return on my investments, a few things here and there when I had just started investing. I thought to myself, I must be pretty good at this. But I remember keeping my money inside those same accounts, and some global events happened and my portfolio tanked. Despite being man-made, the financial markets still follow the laws of nature, which is randomness. And without a proper understanding of randomness, we fall victim to grifters, people who sell you courses and tell you, I know a thing about finance, look at my record, look at how much money I've made, look at the people that I've helped, you should listen to my advice, but also this isn't financial advice. We fall victim to luck, and we fail to understand the way they has such a huge influence on the financial market and in business. But most frightening is that we create careers that are incredibly subject to randomness, careers that can't withstand the test of time. We're going to talk about the role of randomness inside of the financial markets, the role of luck, and what that means for people who dabble in these markets. And then we're going to talk about managing your biases so you have a more fulfilling, robust financial career. Welcome to Business is Scary, where we dissect various business topics and themes like money, marketing, and business management with a human-centric approach. If such topics are of interest to you, make sure you subscribe so you stay notified of all of our weekly content. Now, let's talk about the financial markets. Randomness is defined as the quality or state of lacking a pattern or principle of organization. In other words, unpredictability. And now you might be looking at that and saying, yeah, Victor, I know the markets are unpredictable. That's why if you're able to navigate it, you're twice the business person. We need to apply those principles even further. Would you say I have less skill than an investor in the 1980s who got in on Apple's IPO and I didn't? No, we wouldn't. There's randomness even in what investment instruments and opportunities are available to you at the time when you are old enough and wise enough to invest. When we understand it from this level, we can start to see how a lot of people were just at the right place at the right time. And this is randomness. You can yap all you want about the situation, but there's common consensus that the Bitcoin craze is purely random. When it skyrocketed, there were signs, and there are a few people rallying around it, but in the grand scheme of things, it was a very random event. And maybe you're hearing all this and you're thinking, okay, Victor, whatever, randomness. But understand that the biggest businesses understand randomness, at least to some extent. They have insurance policies to protect them from very random events, whether that's natural disasters, whether that's being a target of a cybersecurity attack. Like all of these things, obviously there are signs, and you can read the signs and you can look at the data and say, okay, well, is this a natural disaster prone area? Sure. But all this illustrates is that there's different degrees of randomness, and there's only so much data we can read. Yes, we've become a very data-focused society, and we have all of these databases full of information from past events. But think about a city that got hit with an avalanche or a volcano for the very first time. There's no prior data that would have told them that that was going to happen. It was the first time that natural disaster hit. That was a very random event. But we're getting ahead of ourselves. I got a lot of this line of thinking about the financial markets from a book called Fooled by Randomness. It was recommended by a friend, and it's now one of my favorite books.
3 cryptos that will go to the moon in 2022.
I don't think I've actually done this for a cryptocurrency one yet. Jeez. Wow. That's unfortunate. That the moon's a lot lower than I thought it was.
The long story short of randomness is that sudden gains can be suddenly lost. And we see this all the time with people who become famous very young, or maybe they became famous for something that went viral. Chances are they're not able to sustain that because they haven't built up the muscles of how to retain fame or retain money. They got it very quickly, so they blew it pretty quickly. It's exactly the same with investing and being inside the financial markets. If you make one really good play and that was your like second play, do you know how to actually read things, or do you know how to actually value a company? You might have just saw one little variable and said, that's the one, invested a bunch, and you were very lucky. That segues us into the next part of this, which is understanding the role of luck. I like to define luck as the winners of randomness. As business professionals, we need to be very skeptical of all winners. Doesn't mean don't like them. It doesn't mean that they didn't deserve their wins or their success. It means we just need to be skeptical. Whew, that was a good point. Want to hear another good point? Most of you are not subscribed. Go ahead and hit the subscribe button. Get involved in the community. It helps the channel. It helps us know what you guys like. And we all get to grow together. So go ahead and, scroll down. Hit that subscribe. Now, back to the video. When somebody parades themselves as a guru of the financial markets, they know which way things go. They read this crash or that crash, and now they're reading a different one and saying, guys, here's the different signs of a recession and a crash and so on. It's not to say they are flat out wrong. All I'm saying is that we put on our thinking caps and we think to ourselves, with how many variables go into the financial markets and how random the financial markets are. Is it really this one variable or these two variables that mean that everything is going to shit?
The same for me as it was for a lot of people was the Bear Stearns call. Back during the great financial crisis, Jim came out and said, hey, Bear Stearns is fine.
Should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine.
And then like a day or two later, they went under.
Nassim Taleb best illustrates this through a game of Russian roulette. Let's say inside this Russian roulette game, there are 4 bullets and 2 blanks. There's a long line of people coming towards this table, and on the table there's the pistol, and they spin it and they pull the trigger. If they get blasted, well, that's the end of their financial career and it's see you later. If they don't, and they get a blank, they get $100,000. And it's their choice. You either walk off into the sunset or you can get back in line and do it all over again. And this can happen indefinitely and for as many times as the person wants to play the game. Statistically speaking, there will be people that play this game 30 times, 50 times, 100 times, 1,000 times. And they're perfectly fine. They hit blank every single time. But we also understand that if this game happens 1,000 times, with enough people, that's a lot of bodies on the floor. Irrespective of the fact of how many people have lost their lives and lost their careers from this game, we will still go to YouTube and we will see how I made 100 million in one afternoon through Russian roulette and how you can do it too. It is irrefutable that they actually made $100,000. It's irrefutable that they survived the game. But we cannot ignore the pile of bodies off to the side in the backdrop of their video.
It's obviously a guy pointing out a stock that he's highlighted in the past that's made a lot of money and using that to probably sell a course from the looks of it. The thing to remember with this sort of stuff is it's kind of misrepresentation at its finest, right? You should never judge someone's merit as an analyst or a researcher or an investor based on individual positions, because this guy, probably has more than just this one stock. And really the only way to judge someone's merit, if you will, is to look at the whole picture, right? Their whole portfolio. Because chances are if this guy is investing in things like, BNGO in this case, which full disclaimer, I know nothing about, he probably has a lot of positions that did very poorly. In fact, he might actually have an overall negative performance because he's picked so many, players that are so risky and, volatile, if you will.
This is a perfect example of the role of luck inside of the financial markets. The financial markets have existed for so long. So many bull markets, bear markets, crashes, recessions, things coming back up, falling, new companies that disrupt the market and hit insane IPOs. Certain companies, they were destined for greatness and then fell tremendously. There's so much that happens. It is without a doubt possible statistically that there are people who made it through all of that unscathed, winners of all of this randomness. Again, we're not saying that they don't deserve it. We're not saying that they shouldn't be there. What I am saying is that understand how much of it is skill and how much of it is luck. How much of it is uneducated big swings, and once you make that one swing, you can just start throwing money at things and problems go away. How much of it is big swings by individual investors versus big swings from multinational companies that can afford to lose $1 million? We have to understand that different people have different investment strategies, and the same dollar amount of investment from one entity might not be exactly the same for a different one. What holds true though is random proofing your life, and that gets into our next topic when it comes to managing your biases. I spoke about it in a different video for podium bias, where we see these people with suits that come on TV and they have all these different trades that they can show you, and they say, guys, look, I am a very successful investor. I'm a very successful trader. Here's my secrets. Here's how I made it through 30 years inside the financial market. Here's how I traded. These are the signs that I saw. It's basically horoscopes for business people, and people still eat it up because we're always trying to find patterns that help us shirk randomness. It's a fantastic video. Definitely go watch it after this one. But we're going to talk about another bias, optimism. We often believe that though statistically something might be very risky or a lot of people fail at something, because there's still that tiny percentage, we often align ourselves with that percentage and believe, I feel like I'll probably be successful in this though. I feel like I know enough and I've done enough research to be able to go into this trade. This is why news sites like Yahoo Finance or Bloomberg or whatever have you are so popular, because we stuff our brain with information about the markets and about where things are going, what's going on in the world. And then we try to make trading decisions based off of that. And we feel better about our decision because we have all this knowledge.
More famous for his stock misses than his makes, like the time he told Elizabeth Holmes she's the next Steve Jobs, or when he told us during Bumble's IPO that it was going to be a growth stock only for it to fall 90% since. Or the time he called Sam Bankman-Fried the next JP Morgan. Or the time he told viewers to buy Silicon Valley Bank before its collapse. Or when he recommended you buy the stock of Chinese ride-hailing company Didi at its IPO shortly before it was fined by regulators and forced to delist. Kramer's picking inaccuracy has become such a widespread joke that CEOs will literally tweet at him not to talk up their companies.
And while that might help some people, it's better to understand randomness. If you understand that no matter what you do, how smart you think this trade is, something going on in some country no one's heard about could disrupt the supply chain all the way over here in the West, that could implode your trade. You'll trade in a certain way. You gotta keep your head on straight. And that's probably the best financial advice that anybody can give you.
When I was a young investor, corrections like this would really rattle me. I would stress over my portfolio going up by $100 or going down by $200 on a daily basis. So I get the panic. I've been there. If you check every day though, you're just going to go crazy. Many people around me, they panic. They let their emotions get the best of them. They sold everything. They never bought in until way later when they just missed a huge opportunity. I stayed patient. I didn't sell. I kept investing. I'm not a gambler. I'm an investor. I wasn't risking it on dumb things. I wasn't doing day trading like so many people did and went bankrupt. Wasn't trying to pick the exact stocks that won. I mean, I did do some individual stock investing, but looking back, I'm not sure I would do that again. I did mostly ETFs. I bought, I held.
Be less emotional about your trades and your portfolio, but then also understand your investing strategy, your risk tolerance. These are very important things to understand so that you can be in investing for the long run. And if you're a trader, understand that you're trading for the short term and not yapping your way into explaining why you've had this stock that you were supposed to trade so long ago still on you because you swear it's going to come back up and you'll be able to at least break even. Whenever you see yourself jumping to a conclusion about an investment or about an opportunity, cool your jets and really think about the risk that you're willing to take on and all the facts that people are bringing to you. Are they using FOMO? Are they actually bringing up why a company ought to be valued in this way? Is it based off of hype, or is it based off of actual tangible things like a product and customers and so on?
Now, I want to be clear. I will never criticize someone who, did the research, tried to highlight their justifications for a stock. In the world of investing, you can have good decisions and bad outcomes. It doesn't necessarily mean that you did a bad job. But the more frivolous stuff, a TikTok portfolio of positions that will take you to the moon in 2022, it's that kind of overconfidence that I think is pretty indefensible. That's why I'm willing to be a bit more harsh on this kind of stuff. Because who's going to consume this kind of stuff? Usually younger, more uneducated people in the world of investing. And there's really no need for it outside of just generating clicks. So I don't like it.
But then also understand that, man, anything could happen. More customers could come from some viral trend that they hopped on. Customers could leave because they find out some really bad thing about the company. The company could file for bankruptcy out of absolutely nowhere because they weren't telling you something. Anything can be random, so just understand that it exists and listen to advice with that in mind, but then also have your financial activity be driven with that in mind. Understand your biases, appreciate nuance, and embrace randomness. You'll be much less likely to make career ending bets. And we definitely need that because business is already scary as it is.